Hello, and welcome to Your Estate Matters with your hosts, my colleague Greg Bernand and myself, Nicole Garten of Heritage Trust.
Your Estate Matters is a podcast dedicated to everything estates, including building and preserving your legacy.
If it's estate related, we'll be talking about it. We're having the conversations today that will help Canadians protect their families, their assets, and their legacies tomorrow. So, Cheyenne, thank you so much for being here with us today to talk about cross-border estates. And we're going to particularly talk about the Canada-US issues, which is quite topical right now. So maybe you can start by telling us about yourself and how you arrived at your current role as a partner with Legacy.
Sure, yeah. I'm from Vancouver. I'm born and mostly bred, although I spent a little bit of time in New York. So after I finished law school at UVic, I decided that I really liked tax and I wanted to do some more in-depth tax learning and applied to a few schools. But New York University has at the time had the best program. No doubt it sure still does. But I decided to go there and do my Master's of International Tax before I articled. And then when I came back and articled partway through, I found the one person in town that was doing that kind of work, U.S.-Canada work, and introduced myself to her. And the rest is, as they say, history.
And was that Elaine Reynolds?
It was, yeah.
So she was a preeminent practitioner and she's retired a few years ago?
Yes, that's right.
Yeah.
Well, what exactly is a cross-border estate? And is it owning property abroad, a beneficiary living in a foreign jurisdiction, and or yourself or a family member who has a different nationality?
Yeah, it's not exactly a legal term, right? It's just sort of a phrase that one can use. And it's certainly applicable when a person has real estate in another country, although sometimes even in other provinces, there are some different complexities that one wants to think about. Even having non-real estate assets in another country can also have its own complications. And so I would think of that as a cross-border estate as well. There are spouses where one spouse is a resident of one country and the other is a resident of another. So that's another example. And certainly where there's a beneficiary that doesn't live in Canada, that would make it also a cross-border estate. So when we're dealing with clients, we're dealing mostly with Canadian residents with those issues, but also U.S. residents, for example, that have Canadian real estate or who have beneficiaries who are in Canada.
So when clients come to you with cross-border estates, what are the main issues that should be considered?
Canada and the U.S. have a lot of similarities and thankfully a lot of differences. But the tax rules are very distinct. And so there's a sort of a presumption that they'll be similar, but they're really not. And so you really have to be careful about how each country is going to tax a particular thing. That's part of it. And then there are also the practicalities of having assets in another jurisdiction or a decision maker who lives somewhere else. How practically can that work? And even for things like investment accounts, most institutions in Canada cannot take instructions from a power of attorney if they're not a resident of Canada. And so a client might have their child who lives in California and is doing really well and financially prudent, and they're the most obvious candidate, but they might not be able to practically act as power of attorney for certain assets.
Let's talk about that issue. Is it because the, say, California resident child that makes them governed by California securities regulation? Is that the issue?
Yeah.
Okay.
My understanding has always been that it's a securities issue, and there are many U.S. licensed investment advisors here in Vancouver and certainly across the country. And for those, it's no big deal. They can quite easily deal with those children.
What are the different approaches to taxation at death that may differ between the countries?
That's a good question. So in Canada, we tax on the basis of capital gains. And so we try to capture the gain in an asset at many points along the way. So for example, when you sell an asset, you pay capital gains tax. If you make a gift to somebody other than your spouse, or if you transfer to most kinds of trusts and sometimes to corporations, and on death, as long as the assets aren't passing to a spouse or a qualifying spouse trust. So that's just sort of the premise upon which Canada taxes our people. And in the U.S., they don't do that. They have an estate tax, which many people have heard about, and they also always ask, what's Canada's estate tax? Even Canadians ask that question, and we just don't have one as such. But the U.S. estate tax at the moment only applies to a U.S. person who has more than $13.99 million U.S. So that's like $18 million Canadian, and a couple of U.S. people, where both spouses are U.S., that's really quite a large estate. So it doesn't hit all that many people. So there's a lot of concern about the U.S. estate tax, but historically it has only hit max 1% of the population, and right now it's quite a bit lower. It's supposed to, on January 1st, 2026, change and go back down to half of what it is now. Now that that the world is a little bit different, the likelihood of it going down is more remote. So there's going to be probably less stress at the end of this calendar year.
What are the main differences between Canadian and U.S. tax, and how does that play into estate planning?
The main difference is mostly this difference between capturing the capital gains tax and the estate tax on death. I'll give you an example. Let's say that there was a Canadian person who's a U.S. citizen. Let's take this as an example. And they have a $10 million piece of rental property, and they paid $1 million for it. On their death, Canada's going to tax $9 million of gain, and the U.S. wouldn't impose any estate tax because they're well below that $13.99 million threshold. On the other hand, let's say that the individual just has a whole bunch of cash. So they've got $20 million of cash. Canada's not going to tax them at all because there's no gain to tax. But the U.S. would impose a 40% tax on every dollar over and above that $13.99 million. So that's one part of it. And then, of course, there are things like RSPs, which are taxed as income. But those are generally more similar, the way that they're taxed between Canada and the U.S.
Is there a tax treaty between the U.S. and Canada? And if so, how does it work?
That's a very big question. And the answer to that is yes, of course, there is one. It's primarily an income tax treaty. And so it generally helps people who are earning dividend income or rental income or business income in one country and living in the other, for example, so that it's trying to mitigate taxes, although there are certain types of income that one country will tax differently than the other. And so the treaty doesn't really help there. Very unusually, our tax treaty with the U.S. also deals with estate tax. And so, for example, that Canadian capital gains tax on death can be offset against the U.S. estate tax and vice versa, which is very great. It's also very helpful because typically for a Canadian person who owns U.S. assets, and that includes obvious things like U.S. real estate, like that vacation home in Palm Springs, for example, but also includes stock in U.S. companies. So, for example, a Canadian person who owns Apple stock on their death, they have at a minimum a filing obligation if they have more than $60,000 of U.S. assets. And that is like most of the population who has an investment account, unless they're exclusively in Canadian mutual funds or Canadian exchange-traded funds that are going to have a lot of U.S. stock. But the treaty between Canada and the U.S. says even though the U.S. rules say that a Canadian or any other non-U.S. person can only exempt $60,000 of assets from the U.S. estate tax, the treaty says, well, actually, we're going to give Canadians a special relief. So if a Canadian person who's died has 25% of their assets in the U.S., they get a credit equal to 25% of what the U.S. person would be exempt from. So the way the math works out is as long as a Canadian couple, say, together has a net worth below the U.S. estate tax threshold, the numbers will work out just fine. But in order to get that treaty credit, an estate tax return must be filed, and it must be filed on time. Otherwise, there is a very large U.S. estate tax liability that can arise.
So there's a lot of stealth Americans here where people were born in Chicago in 1945, and a lot of them, I think now they're aware at least that they need to be filing their annual returns. But do you want to talk to our listeners about the issues that arise in particularly personal real estate that people might not be aware of?
Yeah, and I will say that there are fewer and fewer of those people now who come to me and to others because it's been in the news for so long. Mm-hmm. And many people are under a misapprehension that this requirement to file only started relatively recently, and that is 100% inaccurate. It has always been the case. There's never been a time that a U.S. citizen has not had the obligation to file. But the filing obligations have changed a little bit, but that's always been the case. And I think you're referring to the principal residence exemption. So here in Canada, when we sell our homes, assuming that our house qualifies, no part of the capital gains will be subject to tax currently. And on the U.S. side, that's different. So even if a U.S. person, a U.S. citizen owns their home here in Vancouver, for example, it doesn't matter that it's outside of the United States. If they sell the home, they're going to be subject to U.S. capital gains tax other than on the first $250,000 of gain, or for a U.S. couple, $500,000 of gain, which in Vancouver, it is almost meaningless when they bought the house in 1973 for $61,000, and it's now worth 3.2 or whatever. Having said that, one big distinction that I sort of alluded to before between the way that Canada and the U.S. taxes on death is that whereas Canada taxes capital gains on death, the U.S. doesn't do that. So if let's say this individual who owns their home dies still owning the home, they'll be subject to U.S. estate tax if they're above the threshold and not if they're not. But there is a magical increase in the cost base to that property. So if they have a U.S. child, for example, that inherits that home and then they sell it, they don't have to pay any U.S. capital gains tax on that historical gain. So it works very well for a U.S. person who is carried out of their home in a box, as many of my clients anticipate and expect. Unfortunately, that's not always practical.
So if they sell it before, what happens?
They will be paying U.S. capital gains tax.
Right.
So oftentimes where there's a U.S. citizen spouse married to a Canadian who's not a U.S. citizen, they can engage in some gifting between them. It has to be meaningful gifting. There's reporting that has to be done as a consequence. But there are certainly good planning options to deal with it.
Apart from that, when you talk about gifting, when the families are straddled, could be like American grandparents that lived up here. Now they've got grandkids and they're gifting cash and all that stuff. Does that create problems?
Yeah, and it sort of depends on which way you're going.
Yes.
So for example, well, as a general rule, a U.S. person who's making a gift, they can make a gift to whomever they wish. It's inflation adjusted this year. It's $19,000 U.S. to any person. So that grandparent can make a gift to each grandchild of $19,000 U.S. and they don't have to tell the IRS about it. I have a lot of clients who think that means that is all that they can do, and that is not correct. They can quite easily go over that $19,000. It's just that they have to file a U.S. gift tax return. And they use up a bit of their lifetime exemption. So if they make big gifts, instead of having a $13.99 million exemption on their debt, they've got a $12.8 million. Who cares? For most people, it just doesn't matter. It's just a filing obligation. A bigger, sort of more stealth problem is where we've got Canadians who want to make gifts to U.S. people, as in people who reside in the United States, whether they're U.S. citizens or residents or what have you, because Canadians and other foreign people can really only do that without any U.S. gift tax risk if they themselves stay below that $19,000 limitation per beneficiary. So, for example, if I were a parent of a child who lived in the U.S. and that I wanted to give that child $300,000 to help with the down payment, I would be subject to U.S. gift tax. Yes, it's very difficult for the IRS to ever put that together, but why would you ever open yourself up to that obligation, particularly because the recipient of the gift, they then become, the obligation becomes theirs to pay the tax and so on. So Canadian parent would always want to make a gift to the U.S. resident child's Canadian bank account and let the U.S. kid take their money out of the Canadian bank account. There's reporting that has to be done. My position is generally, if your parent's going to give you a bundle of money, you can file a few forms.
I think so. What are the main cross-border estate administration issues that can come up?
I don't personally do a lot of estate administration, but of course it comes up in planning. Going back to like that treaty credit issue, there's being conscious of what the assets are that a particular person owns, even if they're just Canadian only. If they've got U.S. assets, they do have to file that U.S. estate tax return, which people generally aren't thinking about. So that can be problematic. There's also the question of where is an estate resident for tax purposes. So typically it's handy if a Canadian deceased person who owns their home and some investment accounts, it's handy if that estate is also resident of Canada because, for example, if the home is sold, you don't have to deal with the Canadian withholding tax obligations and reporting and all the stuff that goes along with that. So where the deceased has named only a non-resident of Canada to be their executor, then you're in a situation where in most circumstances, that estate is also a non-resident of Canada. And so you walk into this complexity. So when we're drafting our wills, this is one way to deal with it. And certainly we suggest in most cases that if somebody has also somebody in Canada that they'd like to appoint, that they appoint those two people together, for example. And our wills let any person who's acting appoint somebody in Canada to act with them if they find that appropriate at the time. But the other thing to say is it's not the end of the world. So there are articles periodically that come out in the Globe and Mail and so on that say you cannot name somebody who's not a resident of Canada. And I appreciate that in Ontario the rules are different. They do have different rules about posting bonds and all that stuff. In British Columbia, you 100% can have an executor who's not a resident of Canada. It might be more annoying for them. If they're the sole beneficiary, they're the only person who's going to do it, who cares? It doesn't matter all that much. And then for powers of attorney, for example, it's also relevant where they reside, mostly because of that securities issue that I mentioned before. Any U.S. person who's acting in any of these roles has an obligation to file informational returns associated with having signing authority over a person's accounts or having signing authority over an estate's accounts. It doesn't matter. It doesn't cause them more tax. It's not going to make the estate a U.S. taxpayer. The other thing I'd just raise on that is a lot of times people will have their powers of attorney and they'll sign them and they'll have their kids sign them and their kid lives in the U.S., for example, or is a U.S. citizen or whatever. If that kid has signed it and they already have the authority, then they already, even if they're not exercising the authority, they already have the obligation to report the parents' accounts that are held outside of the U.S. to the U.S. Treasury Department. And it's, again, doesn't cause any tax, but nobody really wants to do that. And it's a privacy issue in part, but also there are significant penalties if it's determined that the power of attorney has not been doing that and they are found out. So we would not generally recommend any U.S. person sign accepting the power of attorney appointment and power of attorney and certainly not even having access to the document unless and until they needed to act, at which point, absolutely fine.
Those U.S. citizens, or maybe they've held a green card that are living in Canada, what are the main things they should be aware of? Like we talked about this primary residence issue. I'm surprised how few clients actually seem to even have been aware of that issue. Like they often come in our office and it's the first time they've heard it. And what are some other issues that if somebody's got dual citizenship or they've held a U.S. green card and they're living in Canada that they should be aware of now?
Yeah, I mean, there are a whole host of them. I mean, green cards are particularly tricky because even a green card that has expired still carries the obligation to file U.S. income tax returns and informational tax returns. And there are many people out there who got their green cards in 1985 and they have them in a drawer because it's a nice little souvenir. But technically, they've been required to file all the way along and be treated as U.S. taxpayers, which is not ideal. And there are also rules that would trigger what's called the expatriation tax if a person gives up a green card after having had it in 8 out of the past 15 years. And so that's really vital for people who are moving back to have to think about that in advance. It doesn't apply to everybody, but where it applies, it's quite problematic. And those same rules apply to people who are U.S. citizens who want to give up their U.S. citizenship, and we deal with that a lot. But there are myriad things that hit U.S. citizens living here, like even just, I alluded to mutual funds and ETFs that Canadians might have, but those are typically taxed more heavily by the U.S., and there are more filing obligations, and so that might not make much sense. Or tax-free savings accounts, which are tax-free for us Canadians, but they're not tax-free for U.S. people. And again, some more filing liabilities. And so it might not make sense to have a tax-free savings account unless you've got sufficient foreign tax credits and all these sorts of things. I mean, I will just add private company shares are also, that's a bigger topic and very technical, but U.S. people who live in Canada who have shares in private companies, whether they're a minority interest or a majority interest, can be quite costly and administratively quite complicated.
And is that with no matter which side of the border that they live on?
U.S. people living in Canada with Canadian private companies,
Yes.
kind of in a similar way, but I would say more complicated and more punitively taxed than a Canadian who would have what's called FAPI income. So like an interest in a private U.S. company, for example, that was doing passive stuff.
I just want to ask a question about people that want to give up their U.S. citizenship, because we see that quite often. They're here, they're going to be permanently here. They don't want to have these issues in their states. So quite often when we've interfaced with your office, Cheyenne, you're helping people basically get rid of their assets in advance, because isn't there an exit fee? And what are some of the strategies people can use?
Yeah. So an individual who gives up their citizenship, say like, similar rules for green cards, but let's just ignore that for the moment. They're subject to 5 different types of tax, sort of, if they are what's called a covered expatriate. And a covered expatriate is somebody who gives up their U.S. citizenship and at the same time had a net worth of more than $2 million at the time. Their average tax over the past 5 years has been quite high. We're talking like over $200,000. That doesn't typically capture people. Or if they haven't been U.S. tax compliant for the last 5 years. So where it's relatively simple, let's say we've got one of a couple is a U.S. citizen, and that individual wants to give up their U.S. citizenship, but their net worth is, say, $4 million or something like that. It's quite straightforward. They can make gifts to their spouse or to their children or whomever they wish, get their net worth below $2 million and expatriate. It's more complicated where there's no spouse, or where there's a spouse but they don't want to give anything to that spouse. But in most circumstances, a person can get out of Dodge if they really want to. Well, but there are circumstances where it just doesn't make any sense.
So what happens? So they had to pay a percentage of the assets over $2 million?
Yeah. So let's say that they decided, I'm going to expatriate, even though I'll be a covered expatriate. And I will say I've certainly had some clients like that. And those ones are typically quite high net worth. And so they can't cheaply make sufficient gifts. And it's, they're really doing it for political reasons. So they just don't want to have anything to do with it anymore. So let's say they become covered expatriates, then they have a deemed disposition of certain assets. And so they'll have to pay capital gains tax other than on the first amount. It changes every year. If they have like the equivalent, a U.S. equivalent of an RSP, an IRA, then that's taxed more heavily. Interest in trusts are taxed more heavily. The biggest one that often comes into play is if that person has become a covered expatriate and they have a U.S. child or a U.S. spouse or any beneficiary who's a U.S. person or anybody to whom they wanted to make a gift in the future, anytime that gift is made or that bequest is made, the recipient has to pay U.S. estate and gift tax at the highest rate. So let's say somebody was a covered expatriate because they had $3 million at the time that they expatriated, but by their death, they were worth $50 million, and all their beneficiaries were U.S. people. That's an enormous amount of estate and gift tax that's
so
payable.
It wouldn't make sense for them to
Well,
give it up.
from a tax perspective, It might not make sense, but that might not matter, right? Like it's same with like residency. And if you leave Canada, you're paying capital gains tax, or you're moving to this country and it's higher tax or lower tax. Live where you want to live and do the things that you want to do. And if there's tax associated with that, so be it.
So one more question. There's so many Canadians that have properties in Point Roberts or Arizona or Palm Springs. What is the way that they should handle, or Hawaii? How should they be structuring those vacation properties?
And the answer, as I think you know, is that it depends. Where the clients aren't going to be exposed to U.S. estate tax, like there's just no likelihood or very little likelihood, then owning it personally, it's fine. Or owning it as joint tenants with their spouse is fine, because then it's going to pass to the survivor. A lot of states have really terrible probate rules. For example, California. Some states have their own estate tax, like Washington, and we don't provide state advice, but we know that is an issue. There are other ways to hold real estate, and if depending on the value of the property and the value of the estate and the family circumstances, things like creating a spouse trust for this specific purpose can work extremely well. I also will say, especially now that the estate tax exemption is so high, I have a lot of clients who are okay knowing that at some point there's going to be some estate tax to pay, because if they're in that circumstance, their beneficiaries are going to inherit enough anyway. And they just want to have the freedom of, spending time where they want to spend time. And if they sell it, great. I mean, the best advice is always just sell the thing before you die. Sometimes that's harder to time than you'd like. I will say, just on that, as a practical matter, if a person has property in Washington or California or wherever, it's really important that they also have a power of attorney that's created in that jurisdiction to deal with that property, so that if they become incapable, the property can be sold.
So we often say make sure you've got a power of attorney in that jurisdiction, but isn't it correct that quite often it's a good idea to have a simple will in that jurisdiction for the property? And do you do those for your clients?
Yes, absolutely. It's a good idea. Some states allow you to do basically a beneficiary designation for the real estate, a transfer on death deed. So those are really great where they're permitted. But otherwise, we always suggest a separate will to deal with that, and relatively simple. We will do them, although our preference is that a local lawyer do them.
Any final tips for our listeners?
I guess I would always just say to people if they're aiming to do something that involves some other country, to ask questions or to find somebody who can answer the questions before they do the thing. Mm-hmm. Because too often people do the thing and then they think to themselves, perhaps I should have figured out what was going to happen as a consequence of that thing.
Good tips. How can our listeners find you? Because I'm sure a lot of people will have questions, or they will be covered by these issues.
I'm at Legacy Tax and Trust Lawyers. I can be found at our website, which may be new and improved by the time this goes out. We'll find out.
Well, thank you very much for coming, Cheyenne.
Thank you for having me.
This podcast is for informational purposes only and should not be considered individual legal, financial, or tax advice. Make sure to consult the advisor of your choice to advise you on your own circumstances. Thank you for joining us for this episode of Your Estate Matters. If you like this podcast, make sure to follow it on your podcast platform of choice.
Whether you are planning your own estate or you're acting as executor for somebody else's, Heritage Trust can help. Partner with Heritage Trust to protect your family, your assets, and your legacy.
If you would like more information about Heritage Trust, please visit our website at heritagetrustcompany.ca.
This podcast is produced by Podfather Creative.